Welcome to Perspicium. I'm about to show you something that will fundamentally change how you think about market timing. There's a tool that gets a lot of attention, people talk about it all the time, but a few truly understand how to use it and how powerful it actually is. That tool is seasonality. What if I told you November has been the most rewarding month to be invested in the market, outshining every other month on average over the last 25 years? What if I told you some months consistently deliver higher average returns with 90 to 100% win rates, while others quietly bleed capital year after year? What if I could show you how to capture 80 to 110% of the market's upside while only experiencing 60% of the drawdowns? This is not luck, this is not coincidence. It's a statistically significant pattern. Today, we are diving deep. We will learn a comprehensive seasonality analysis using 25 years of historical data, risk adjusted performance metrics, real world strategies that turns knowledge into alpha. This isn't fortune telling, this is quant finance, and it's all available on perspicium.com. There are a few powerful forces that consistently drive seasonality patterns in the stock market. These can be grouped into four key pillars: business cycle, institutional flow, behavioral finance, and earnings seasonality. Let's break them down and see how each of them contributes with real world examples. December usually sees institutional rebalancing and tax loss harvesting. January brings the January effect, where small caps usually tend to rebound after December's tax loss harvesting. In Q4, holiday shopping drives strength in consumer discretionary stocks, and two of the most notable psychological seasonality effects are sell in May, go away, and Halloween effect. By the way, I'm using Perspicium.com, my own quant analytics dashboard. It's completely free, no login, no credit card required. You can explore monthly seasonalities, quarterly seasonalities, how each weekday has been performing, and how each calendar day has been performing. These all go back as far as 25 years and come with summary statistics at the bottom. Up there, you can see percent of time it was positive, expected return, median, max, and minimum performance. Before diving into the strategy itself, let's take a step back and look at the raw data. I analyzed 10 years of historical market performance to identify monthly trends. Unsurprisingly, November stands out as the best performing month, while September ranks as the worst. Over the last decade, July delivered a positive return 100% of the time, and November, May, and June were up 90% of the time. On the other hand, February was positive only in 40% of the years, making it the most underwhelming month in the dataset. Let's talk about how you can profit from this, or at least protect yourself from the downside using this data. In the strategy, I selected range of assets from major indices to individual stocks and only invested during the months historically shown to be strong. But an important question arises: how many months should you include? In my testing, I found that including too few months limits the upside potential and makes it difficult to outperform. Conversely, including too many months dilutes the seasonality edge, making the strategy resemble buy and hold. So I picked 6 months. That seems to be a good middle ground. To avoid look ahead bias, I calculated seasonality patterns using data from 2000 to 2020 and ran the backtest on out of sample data from 2020 to 2025. When I ran this strategy on SPY, seasonality strategy captured 84.3% of the upside compared to the buy and hold, with a slightly lower CAGR of 13.3% compared to 15.78%, but with 25% lower volatility and improved Sharpe ratio, 1.01 compared to the 0.93. Average drawdown also improved by 5.58%, and if it wasn't for the tariff dip, probably seasonality strategy would be on top. For triple Q, the seasonality approach performed even better, capturing 95% of the upside with a CAGR of 15.9% versus 16.7%. Risk adjusted performance also improved, with a Sharpe ratio of 0.92 versus 0.78, while volatility dropped by 23% and drawdowns improved significantly, minus 22% compared to minus 35%. Tesla's seasonality strategy, however, captured only 52% of the upside, with a large drop in CAGR from 24% to 12%. Although it did reduce volatility by 29%, it was suboptimal. Microsoft showed similar underperformance in return, with the seasonality CAGR at 12% compared to Piano's 20.2%, capturing 62% of the upside. It reduced drawdowns and volatility, but Sharpe ratio also slightly declined. GLD significantly underperformed under the seasonality strategy, capturing only 45% of the upside with a much lower CAGR of 5.7% compared to buy and hold's 12.5%, and drop in Sharpe ratio from 0.85 to 0.56. While the strategy did reduce the volatility by nearly 29%, it was mostly upside volatility, and the main reason for the underperformance is structural. Since 2020, gold has been in a broad, sustained uptrend, and even sitting out just one strong month led to disproportionate hit in returns. In trending assets like gold, being underexposed at the wrong time, even briefly, can cost you big. The seasonality strategy works best in cyclical stocks or ETFs, and less so in steady climbers like gold during bullish regimes. If you're wondering how to actually use seasonality to beat the market, not just reduce volatility like a hedge fund or an institutional investor would, here is something interesting. Most retail investors care about growing their portfolio than optimizing the Sharpe ratio. So I built strategy that uses seasonality from S&P 500, but instead of investing in SPY or S&P 500 proxy, it invests in UPRO, a 3x leverage S&P 500 ETF. Why? Because Sharpe ratios don't change with leverage, but your returns do. The results: this seasonality strategy on UPRO delivers CAGR of 32.9%, outperforming even buy and hold, which is a strong 30.8%. And despite the leverage, it still reduces max drawdown by over 13% and cuts volatility down by 25%. So you're getting higher returns with less pain. That's how seasonality becomes more than just theory and turns into real outperformance. Seasonality isn't hype, it's an edge. After going through decades of data, we confirmed one thing: seasonality works, especially on broad indices like S&P 500 and Nasdaq. It especially shines in index level rotation during historically strong months, but it also struggles with high volatility tech stocks, broad bull markets, and black swan events. This isn't a crystal ball, it's a probabilistic edge, one backed by data. Seasonality isn't magic, it's math. It's not about prediction, it's about preparation. And it's certainly not a get rich quick scheme. It's a way to manage risk, whether you're growing wealth or protecting retirement assets or just trying to reduce volatility in the market. Seasonality gives you a repeatable, measurable, predictable edge. If you want to try these out for yourself, go to perspicium.com. It's completely free, no login, no credit card required. And if this video helped you, give it a like, hit that subscribe button, and share it with someone who you think will benefit from this. Thanks for watching, and I'll see you in the next one.